Warren Buffett and Berkshire Hathaway are role models for many investors out there. Many investors look to their portfolio and their investment strategy for investment ideas, and some investors believe in them so much that they directly buy into Berkshire shares to show their support. So I spent some time looking at their portfolio recently and came up with a list of 5 of their holdings that are currently undervalued or on sale, if you will, in my opinion. So we're going to go through this list here, but guys, if you're brand new to the channel, make sure to smash that like button down below and subscribe as well if you want to see more content like this. If we get enough interest on this video, I'll create another video on Buffett's portfolio with 3 premium holdings that he has that are on sale. Now keep in mind, his portfolio is currently worth hundreds of billions of dollars. So some positions, although they may be small on a percentage basis, are still large on a dollar basis. Also, make sure to stick around to the end of this video and watch it all the way through because I cover my personal favorite of these 5 picks at the end. So the first stock here is Restaurant Brands International, which is a fast food company that owns Burger King, Tim Hortons, and Popeyes, and makes up 0.22% of Buffett's portfolio. QSR, which is their ticker symbol, is currently down 38.5% from its highs, and during the current shelter-in-place measures the last month and a half, their business is suffering. This company relies on consumers to physically come to their stores, either walk-in or drive-through, to make purchases for food and drinks, and along with other fast food giants like McDonald's and Starbucks, traffic has been hit recently and has plummeted. That being said, the last few years for this company has been good. It's been growing well. It's been pulling in almost $6 billion in revenue and $500 million in profits. It's not quite as impressive as McDonald's or Starbucks, but it is still a decent business, and I expect a business like this to rebound fairly quick once the economy gets opened up once again. Obviously, food is something that people will still need, and old habits of picking up, say, a Whopper during lunchtime will probably resume once we get some sort of normalcy back in the environment here. Now, I think this industry is poised to recover quicker than expected and will be back on track within a couple of years. Restaurant Brands currently yields 4.3% in dividends with 4 years of growth. However, the payout ratio is currently very high. Because of recent situations, the company is in a tough spot here with paying dividends as their income has been directly affected. I would say this dividend is at risk of being cut if it hasn't already been cut. That being said, I wouldn't own this company for the dividends because the capital appreciation in the stock seems more attractive to me personally. The current market cap sits under $13 billion and the PE is just around 20, which is actually cheaper than its competitors McDonald's and Starbucks. So this company may be a value play here, if you will, when it comes to fast food. So Restaurant Brands, although not my favorite stock in this space, is still a good company, and they do own some pretty reputable brands around the world, which could and probably will help it get back up to where it was before this crisis hit. Our second stock here is Wells Fargo, which I covered recently in depth in my 3 stocks for May 2020 video, so make sure to check that out after this video. This financial giant makes up 7.18% of Buffett's portfolio. Wells Fargo stock is currently down over 58% from its highs and may be one of the more attractive banks to own currently based on valuation. This company, like other banks, will be affected by lower interest rates, but the company has proven to remain strong even during these times and these kind of environments. They held steady in 2010 to 2015 when interest rates were extremely low, and they pulled in consistently around $90 billion in revenue and $21 billion in profits. In recent years, the company has started earning more due to interest rates rising, and I wouldn't be surprised to see this hurt for the next few years as rates are back near 0% for the foreseeable future. Nonetheless, I think Wells Fargo will be just fine, and even with lower earnings, should still pull in billions of dollars in revenue and profits. The dividend of Wells Fargo is outstanding currently, yielding 7.39% with a good 9-year growth history and respectable growth rate of 7.3%. The payout ratio may have some concern, however, because it is high and we are expecting earnings to decline in the foreseeable future, and I think this 7% yield may be a bit unsustainable. I wouldn't be surprised to see this company cut back to around 3 to 4% yield, which is in line with other large banks as they weather through this storm. That being said, the company did report their earnings recently and didn't announce any cuts to the dividend, so they may stand strong here in hopes that the economy rebounds quicker than expected. Wells Fargo is sitting at a $113 billion market cap and a 6.8 PE ratio, both of which are very low for this company in my opinion. Although the PE will rise and revenue will fall, I still think a $113 billion market cap for this bank is too low. Many estimates out there say that they will probably bring in around $70 to $75 billion in revenue over the next few years. So based on this metric, the $113 billion market cap is too low. For comparison's sake, JP Morgan Chase is trading at nearly 3 times expected revenue after their 2020 decline, but Wells Fargo is trading at less than 2 times their expected revenue. So in my opinion, there may be some mispricing going on here in Wells Fargo stock, which you could take advantage of as an investor. So I like Wells Fargo stock as a bank here. I like it as a financial stock, and I like it as a dividend stock. It gives you good exposure. I believe it's pretty undervalued right now, and I think this is a relatively stable company going into the future. Stock number 3 is Globe Life, which is an insurance company and makes up 0.28% of Buffett's portfolio. This stock is currently down around 28% from its highs and is an attractive insurance play. More specifically, they do life insurance based out of Texas, and they are also a component of the S&P 500, although many of you have probably not heard of this stock before. Insurance is usually pretty profitable and a consistent business, and this is clearly seen by the growth of this company over the years. Revenue has been consistently climbing, hitting over $4.5 billion in 2019, and profits sat at $760 million. Margins look pretty good for Globe Life, and despite the global issue right now, this company should not be affected greatly by it. The starting dividend yield here is less than 1%, which isn't too attractive, but they have a good history of their dividend payments. They have 14 years of growth, and they raised this dividend by nearly 8% year over year. The best part though is their payout ratio, which is incredibly low at 10% and gives this company a lot of flexibility and tons of room to grow this dividend over time. This could be a very strong and consistent dividend company, and they're more than halfway there to becoming an aristocrat as well, so this could be a good one to watch for going into the future. The company currently has a market cap of $8.5 billion and a PE of 11.5, which is low, and considering they pull in $4.5 billion in revenue, they are trading at less than 2 times here. This could signal that they are extremely cheap currently. But that being said, although this company may look cheap, I would strongly suggest that you go and take a look into their 10K, their 10Q, really read up on this company and try to understand the insurance business as a whole, because it is a complex industry. And you also may want to compare this to its peers to see if this is a worthwhile investment. But from a high level here, this looks like a very strong business. Stock number 4 is Synchrony Financial, which is, as the name implies, another financial company, as Buffett absolutely loves these. This company makes up 0.31% of his portfolio. So this stock is currently down around 54% from its highs, so you're getting this company at a good discount relative to where investors found value in it before. Now the company is similar to American Express in that they have loans and credit cards, and they provide private label credit cards for companies like Amazon and Lowe's. This company has one of the smoothest revenue and net income charts I've ever seen, consistently growing year over year since 2012. In 2019, revenues were $19.5 billion and profits were $3.75 billion. This is not too shabby. However, similar to its peer American Express, they are expected to take a hit to their revenues and profits in 2020, which is a big reason the stock is down currently. If you believe this company can rebound in the next 5 years and continue growing like it did before, it could be a great play at these prices. Now with the dividends, this company doesn't have much of a history here, and quite honestly, I'd consider this more of a growth company than a dividend company. That being said, they have a yield right now of 4.75%, but only 3 years of growth and a very high payout ratio. And I would say this company is at a high risk of having their dividend cut here if it hasn't happened already, which is probably another reason investors sold out of this business recently. Now the company is trading at stupid cheap values currently with a market cap of $11 billion and a PE of 3, and even if we see this PE double or triple in 2020, it would still make Synchrony Financial a cheap stock to own. And this reminds me of another company that I've covered here on the channel, Discover Financial, which is in a very similar situation. Now, my opinion here is that I think that the market is being extremely pessimistic and unfair to these kind of companies like Discover and Synchrony and even American Express. So if you understand this industry well and you think that there's a lot of potential for these kind of businesses in the future, then these valuations that we're seeing right now are stupidly cheap in my opinion. Stock number 5 is a new stock on here we haven't discussed, and that is StoneCo, which is a financial software company and not your typical Buffett type investment. However, this makes up 0.23% of his portfolio. StoneCo stock is currently down almost 44% from its recent highs and may be providing good value here considering it is a growth name. This company is based in Brazil, so you're getting international exposure here as well. And what they allow to do is allow merchants to conduct electronic commerce across in-store, online, and through mobile channels. Now, this company IPO'd recently, so there isn't too much info on their history here. But year over year, you can see that there's some big growth happening here, where they pulled in $650 million in revenue and $200 million in profits in 2019. So these signify some pretty good margins. And guys, when looking out a few years for expectations for StoneCo, their revenue is expected to explode to nearly $3 billion this year and over $5 billion in a couple of years. And along with this, profits are also expected to rise substantially, and they're expected to pull in over $1 billion in profits by next year. But of course, being a growth name here, this company doesn't pay any dividends, and it does have a rich valuation. The current market cap is $7 billion and the PE is nearly 40, so it's richly valued even after dropping significantly in recent months. That being said, I really wanted to throw this stock here in my top 5 Buffett picks really, because it's a growth name and you typically don't see Buffett holding growth companies that often. So this really intrigues me. I'm going to try to look into why they are holding this stock and what kind of potential they see here. So this is a company that I will personally be researching a lot more. And if you want to see a dedicated video on this or any of the other stocks that I've covered, guys, let me know in the comment section down below. So now the fun part, if I had to pick one of these 5 companies, which one would I personally pick for my portfolio? Well, after considering all of these stocks, I think that I would have to go with Wells Fargo. This company is a giant in the financial space. It's a reputable brand. And they also came out of the great financial crisis without too many scars, which leads me to believe this is a pretty well-run company, at least from a financial standpoint. They also have a new CEO, which used to be Visa's CEO, so I think he can drive a ton of growth here and innovations with this brand. Not only that, you're also getting an extremely attractive dividend yield right now, and you're getting some really cheap valuations on the stock with tons of potential for capital appreciation as well. So it's really hard to not really like this investment for a potential financial exposure play. Now, personally, my favorite in this sector is still JP Morgan Chase. I think that brand holds its own value and should be traded at a premium compared to Wells Fargo. But that being said, looking at today's valuations, Wells Fargo, it's hard to pass up on. Anyways, guys, let me know what you thought of these 5 picks in the comment section down below. And remember to drop a like on this video if you want to see some premium stocks from Buffett's portfolio, which I believe are on sale right now. Either way, guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.